Oh, that's good. Ours was fried chicken. That's all.
Okay, I'll open it. You never know.
All right. Jeff, are you ready to go? Okay, we just need to wait for the cameras and then ready to go? Ready? Yeah, I'm ready. Okay, good morning, everyone. Good morning. And welcome to the February 26th meeting of the New York City Employees Retirement System, which is being held at 335 Adams Street, the 22nd floor. The first request today is an addition to the, oh yes, sorry, we need to call the roll, please. Thank you.
Chair.
Present.
Controller's office.
Present.
Public Advocate's office.
Present.
Borough President Manhattan.
Here.
Borough President Brooklyn. Here. Borough President Queens.
Here.
Borough President Staten Island.
Present.
Borough President Bronx. International Brotherhood of Teamsters. Here. Transport Workers Union.
Here.
District Council 37.
Here.
We have a quorum.
Thank you.
Madam Executive Director, I'll be coming in a meeting, he'll be here a little bit later.
Thanks. We have a request for an addition to the agenda today for your approval, and it was an item that was laid on the table at the regular board meeting in January?
No, February 14th.
February 14th board meeting regarding loan fees from the plan. And I believe, I wasn't at the meeting, but I believe the board requested that it be discussed again at this meeting. Does anyone have any objections to adding the loan fee item to the agenda this morning? All right. So any other changes or requests to the agenda? Okay. So I'm going to pass out the resolution. Thank you. And are you ready to discuss this?
The resolution is slightly modified from February 14th when we initially brought it to you and discussed it. As you'll recall, although there are some different folks on the board here, but the concept is to reduce the loan fee for Tier 3, 4, and 6 members who are eligible on a temporary basis in order to promote the online utilization of loan applications. And the change that we made was to just say that we would reduce the fee for promotional purposes for up to a 6-month period. And we had previously just said for a temporary period, so we made it more specific. And in addition, we indicated that the executive director would report back the results to the board and make any recommendations with respect to future changes in the fee. That's pretty much it. We need a motion.
So,
Yes.
You may have said, and I may have not heard it, I believe the fee now is $40.
$40.
And we're talking about going to 30?
No, we don't know what we're going to do. We're sort of, the idea really is that it's more cost effective to do it on a online basis. Right now, about 30% of the loans are done online, so we want to do this promotional campaign to expand a variety of online services, including the loan fee, and we thought we would reduce the fee temporarily to promote the utilization online. At the end of the day, when we complete that process, we want to do an analysis and see really what kind of buffer do we have in terms of our budget relative to the loan fee, and then make a recommendation to reduce the fee overall for all the members based on the outcome of that experience. So we really don't know the numbers yet, but right now the fee is at 40. And we thought for the promotional campaign, we might go down to 30 or even 25, depending on what we could withstand. Okay.
Put the dollar figures in?
No, we don't really know the dollar figures yet. We're still figuring them out. But when at the end of the day, after we do the,
I mean, the 30 or the 25 for the promotion.
well, I don't think we've made a decision, and it's sort of, it's finance and Sharif and those folks have to come to some sort of consensus on what they think is appropriate. But it will be somewhere in that vicinity. Okay? All right.
Do we need to read the resolution?
No, we just need a motion.
Okay, do we have a motion to adopt this resolution? Do we have a second?
Second.
All in favor?
Aye.
Any opposed? All right, thank you.
Thank you. That's resolution number 1.
The next item on the agenda is the December monthly performance review. Larry?
Okay. Does everybody have their monthly package?
Yes.
Living color? Okay, just a quick overview and then I'll get you to the numbers. You may recall from the last meeting, the last quarter really was, the last quarter of the calendar year, a variety of risks that were looming over the markets went away. And as a result of the risks going away, there was a nice calm, euphoric rise in the stock market in particular. That then led to sort of what I'll call overthinking what the Fed's going to do, because the Fed's been pretty adamant about the keeping rates low, but the market seems to want to not really listening very well to the Fed, and then start to raise interest rates. But again, that's sort of taking care of itself a little bit in the markets. I would also tell you that the U.S. economic recovery is slowly becoming a reality. If you look at all these economic charts, they're all kind of trending up. That's the good news. The bad news is they continue to trend up very slowly. Because if you think about it, the crash was in 08, 09, so that's 9, 10, 11, 12, and this is 13, so it's the 5th year, and we're still muddling along at 1 to 2% growth, so not very good. As much as the risks, some of the risks in Europe went away, and they were sort of calm, and the sovereign, European sovereign market has come down nicely for as far as interest rates are concerned. No one has paid back a nickel or a euro of debt in Europe, so the European debt overhang remains. So I would tell you there's something of a false sense of security as to what's going on in Europe, which was dramatically interrupted yesterday and is being interrupted today because the Italians are having their election and they haven't quite figured out who's going to be in charge. So of course people said, oh my gosh, there's really still risk, so the stock market tanked yesterday.
I think the comedian did a very good percentage.
He did, he got 25%, so we should put him on David Letterman and see how he does. It tells you something about what people are thinking, right? 25% is some number. That all being said, again, corporations are very flush with cash. To the extent that things like the M&A business slowly picks up means that they're feeling more comfortable about spending that cash. And that's sort of picked up if you look at the Heinz deal or Dell. So I would tell you it's a sign of business confidence slowly coming back. But again, if you look down, a couple hundred miles to Washington, you've got this budget sequester that's supposed to happen on Friday. That's not a very good sign. So let's say it's sunny with clouds on the horizon. Well, the clouds were dissipating, but they keep coming back. So the big risks in the fall are gone, and there was what I'll call relief, and now clouds are coming back in. So what that meant, if you go to page 39, so again, I tend to focus on the left-hand side. In 39, at the top cluster of numbers is the U.S. stock market, which in December was sort of up, let's call it 2 to 3%. The European and international markets were up 4 to 5%. That meant that people got out of safe things like governments, so the government market was down 1% or so. And then to give you a flash into January, which is the next page, people realized they didn't want to miss anything, so January the stock market in the U.S. was up 5 to 6%. Same thing with the international markets. And again, the safe securities went down a couple of percent. So all things were good, although February, as we're seeing it, the first couple of weeks were good, and now it's kind of bouncing around as some of those clouds I mentioned become apparent. So if you go back, I have to reorder these slides one day. If you go back to page 32, sorry. That meant that if you look at NYCERS values, we're at an all-time high at the end of the calendar year of 44.2 million. And then if you remember those good January numbers I told you, we're probably north of 45 billion. Again, an all-time high and a very good increase from the beginning of the calendar year last year. And if you look on the next page, page 33, you can again see the highest ever on a 10-year basis, and the 10-year return is about 8%, notwithstanding this very, very bad drawdown that we had in fiscal year 09. So back on track. We're probably about similarly as I described to the economies. You know, we got some clouds out there, but pretty good.
And Larry, the comment at the very bottom of the page, 10-year return is December 31, 12 at just about 8%, in spite of what was a pretty difficult 08-09.
All right, I can't hear you.
The 8% return for the 10 years ended December 31st, shown at the bottom of the page, includes an awfully difficult 08-09 time frame, as you pointed earlier.
I think Callan's done a great job. As has the trustee. I haven't been here. So all the good work of others. If you look at our asset allocation on page 35, we're pretty much in line with everything. In December, we were a skosh under in tips and a skosh over in high yield. We fixed that in January, so we're back in range with all the numbers. And if you look at the how much money we made chart, which is on page 41, you'd find that for the month of December we made 1.5%. So the fiscal year to date we're at up 6.8%. I think we made at least 2% in January, so I would tell you we're probably at around 9% at the end of January. You know, we only have 5 months left for the fiscal year to make 7, so far so good. All the numbers of all the asset classes are positive, you know, plus or minus a skosh again. So I think we're the portfolio is well positioned. We're making money. You know, stay tuned for next month's report. Any questions? Right. So now we have I think there was a request last meeting or the meeting before about risk. So we have John Bright, our head of risk. He's going to walk you through a big picture view of risk. Please. It's in your book, starts on page 65.
Larry always wants me to remind everyone of my background, and I usually mutter something about having been a physicist and then a risk manager, and that's the extent of what I tell you all. And it's not out of modesty, but if I start talking about myself, I can go on forever. But I think since a number of people looking at this presentation have said, is this a risk presentation? Is this what a risk guy does? Is this an actuary, accounting, a consultant? You know, it doesn't seem to be what traditionally people think of as a risk presentation. I should probably tell you a little bit about what I did as a risk manager and what we looked at. And our mandate at every firm I was at, it varied slightly, but it was essentially to ensure that we avoided unacceptable losses, where unacceptable was completely undefined. But what it meant to me and to the firms was losses that were, terribly large, or sudden, or stupid and embarrassing. And we're going to get us in the journal. How could a big investment bank have been so dumb as to lose money in this particular way? So what risk managers do is spend a lot of time looking at how people lose money. And it comes down to roughly 3 ways. One of them is you're in a really good trade. You're in a perfectly good trade. It is going to eventually make a lot of money, but there will be bumps along the way, and you haven't provisioned properly for liquidity. And you
John,
get,
sorry, could you speak up, please?
I do my best, but it's a big room. Yeah, I don't have a loud voice.
AC is on.
Yeah.
Yes. So what can happen is you get forced out of the trade prematurely. Great example is Johnny Corzine and MF Global. That would have been a great trade. We've had a spectacular credit rally in Europe, but they got forced out early and bankrupted. So risk managers spend a lot of time worrying about the funding side of the firm. Do we have enough funding? Do we have enough willpower to get through the big downturns? Another way firms lose money is you apply a model, a paradigm from one market to another to which it doesn't really fully apply. Good example there is looking at all the expertise that was built up trading developed currency options and people applying them to a peg currency, the Mexican peso. And tons of money were lost during the tequila crisis when the peso devalued dramatically and suddenly. But the favorite way is mismarking your books and valuations that are simply wrong. And the problem there is it sends bad signals. The traders think they're making money when they're actually losing money. So they do more and more of it. And eventually when you wake up, you have a big loss. And the best examples of that is the behavior of sovereigns who have strange accounting. And Greece is just only one example of a sovereign who hid losses for years and years and then suddenly recognizes them. And when something's hidden for a number of years, when it eventually blows up on you, it's much, much worse. So as a risk manager, I spent a lot of time looking at our accounting, at our valuations, and in fact had product control reporting through me, who was a team of 50 accountants who were responsible for the valuation of all the squirrely stuff we had. And spent a lot of time with Treasury, worrying about our liquidity, and did we have staying power to stay in trades. And also spent a lot of time, and you wouldn't think you would in an investment bank, but we own an insurance company at Merrill Lynch. We were in the business of tax-deferred variable annuities. There's a quirk in the tax law where if you're holding some assets against an insurance policy, they grow tax-free. So there's a big retail business in deferring taxes by putting the money into an insurance policy, which is essentially an investment vehicle with a death benefit tacked on. And there the issue was, as the product evolved, more and more bells and whistles were put on. Your death benefit would grow 5% every year, or it would be the maximum value of your investments, which were effectively puts on the equity market. And the question arose, do we value the puts as the capital markets would value them, or do we value them with our then current actuarial assumption that everything was going to grow at a very familiar rate of 8%? And so these sort of questions about valuations and the assumptions are core to what a risk manager does. So I've told you all this because this presentation, and I'll tell you, the one thing that I hardly ever did, or no risk manager hardly ever did, and maybe 5% of our time was devoted to it, was value at risk and volatility and statistics. It simply wasn't how we were going to go about losing money. It was largely irrelevant. The regulators demanded it. It was comforting to them, but it was largely irrelevant. So having spent the last presentation to you all going through all the statistics, just to even things out, I'm now going to step away from that and talk about risk much more generically. And to me, the risk of a pension fund is that our returns aren't enough to meet our liabilities, plain and simple. We don't throw off enough money to fund our benefits. Now, in normal times, and by normal times I mean when the Fed hasn't artificially depressed the level of rates to historically low levels, maybe your actuarial assumption is 8% and corporate bonds are earning 6%, and so they don't quite get you there, but they're close, what you're going to earn in fixed income. And so then you add some more risk with equities, but your big risk there, since you're already fairly close to hitting your bogey, is a sudden downturn. You're too concentrated. You have everything correlates with everything else, and you lose a lot of money in an equity crash or in some other way, and it takes you forever to climb out of the hole you just dug. So in that sort of environment, all the statistics become very relevant. Sharp ratios, correlations, value at risk, etc. What I want to argue is we're not in a normal environment at all now. The Fed has made rates, and now I'm on page 5 of the presentation. The Fed has made rates very, very low, and shows every indication of continuing to keep rates low for the foreseeable future. So, effectively, on the fixed income side, we're lending to corporations, we're lending to the federal government at a blended yield of roughly 2%. And we're borrowing from the future implicitly through our actuarial assumption at 7%. This is a big gap. Think of it persisting over 5 years. You're making 2%, you're paying out 7%, you're 25% behind after 5 years on that portfolio. That's the size of a good-sized equity crash. It's just happening in slow motion. So let me just talk for a little bit about the effect of interest rate changes on the portfolio. First of all, let's say if interest rates were to go up, say 500 basis points tomorrow, we take a mark-to-market loss, the duration on it, roughly 6 years, 5 years. So on the fixed income part of the portfolio, we would take an immediate hit of 25%. But over time, we would more than make that up, because now we'd be accruing at 7% instead of 2%. So the flip side of that is also true. The joy we get in a rally that we had in treasuries in 2008 is short-lived. Yes, we get a mark-to-market gain, which offsets some of the losses in equities, and we're all very happy. But then we have an accrual rate of only 2%. And the next slide shows, in the long run, the accruals win out over the mark-to-market hit. You know, if we say we have 15 billion roughly in fixed income, so we had a sudden backup in rates, we'd lose money, but by year 6, we're in the money. The flip side's also true. The joy we got in 2008 from the Treasury rally, we've essentially given back right now from low accruals. We don't see it happening because it happens gradually, but we're accruing it now at a much lower rate in that portfolio. So what's the effect? So to me, the paramount risk facing this fund is the Fed continues doing what it's doing. I'm less worried about a mark-to-market hit from rates going up. I'm worried that rates stay low for the foreseeable future. How do you earn enough if rates stay low as a pension plan? It makes our liabilities much farther away in any real sense. It's harder to get there. So the actual rate's 7% after expenses. A third of the portfolio earns roughly 2%. That means the rest of the portfolio has to earn 10% just for us to break even. That's possible, but it's very heavy lifting for the part of the portfolio that's doing all the work. Private equity, real estate, etc. Might happen, we all hope it might happen, but it's difficult. Is there anything we can do to mitigate that risk of low rates and the difficulty of meeting our bogey if rates stay low? Well, yes. I would argue that in a low rate environment, you want to be a borrower, not a lender. We could accelerate reducing our allocation to core plus 5. Lending to sovereigns, and particularly the US government, is very safe. They're not going to lose a whole lot of money, but they're not going to accrue much either. Expand the rebalancing ranges to give more freedom. And accelerate what we're already doing, which is investing at the bottom of the capital structure. Private equity, the equity tranches of real estate, high yield, these are all implicit borrowing because the people we're investing in are borrowing at these historic low rates. We also might want to seriously think about explicitly levering the fund. And the next slide shows if equities and alternatives yield 10%, so we have 2/3 there, 1/3 roughly in fixed income. We have our current VAR of 2.4 billion, and we meet our bogey. We earn 7%. But if equity and alternatives only yield 7%, then we'd have to be 100% in that. We'd have to get rid of the part of the portfolio that is not earning at a sufficient rate. And the VAR would go up proportionally, 3.6 billion, and so on. So what's the moral of the story? If we have middling returns, not terrible returns, but just not really good returns in equity and alternatives, with our current level of fixed income, it's going to be very hard to meet our bogeys. So we have to have leverage in that environment to avoid falling behind and requiring additional contributions from the city. The leverage can be indirect by investing at the bottom of the capital structure, or explicit, using futures or margin to boost the yield. There are two real constraints. One is the basket clause, and you all have already voted to, I understand, to try to get Albany to raise it. I think that's a vital necessity to the funds. The other is, and this is perhaps more difficult for everyone, but we may have to accept much more short-term volatility, what people we usually call risk. But to me, the bigger risk by far facing us is falling short of our earnings assumptions, slowly but inexorably. And so volatility may be an appropriate trade-off at this point, to incur greater volatility, to increase our chances in a low-rate environment of meeting our investment objectives. And now, any questions?
Yeah, I guess a few things, and I will preface this by saying there is no way that I'm going to get into an intellectual risk argument with John Bright. That's his area. But I guess a couple of questions, John. I guess first of all, sort of I think somewhere there you talked about avoiding unacceptable losses is one of the paths to this, and I guess kind of following on my comment to Larry earlier in the performance presentation, 08-09 would, I think, by both definitions be a definition of an unacceptable loss for most people. So I guess taking that, part of I think what we're talking about here may be a different form of timing. One of them is, I think, from what I'm getting, the time frame you're looking out over here in this is the issue of sort of 2 to 5 years.
Yeah.
Traditional capital market look and the way portfolios are structured tend to take a look over 5 to 10 years. Yeah. And Bob will tell you he looks out over 30 years and longer. And so I guess part of the reaction, and this comes from a consultant who helps develop asset allocation, is that the long term is the driving force here, and so the asset allocation that the fund has is long term in nature. So I guess that's one aspect of it. I guess from our view, there are also associated risks with the type of moves that you might have talked about back on page 9. More equity exposure exposes you to a different form of risk that can be short-term in nature. And I guess where we do agree is that the expansion of the basket clause is one of the key tools that can be used to mitigate some of the risks that we talk about and the ones that you're talking about here. So I think that's important. I guess from our standpoint, the portfolio has been diversified to a large extent with risk diversification in mind, but nonetheless, we have pretty heavy exposure to equities already.
Yes,
At a 70-30, and going further than that adds a level of risk that I think we'd want to see some more, a lot more work before anything was determined by the board to go further. I guess in terms of fixed income, the couple of things is the high quality aspect of this portfolio has presently a 19% allocation to core plus 5, and of that, Martin, you can help me, maybe half of that is treasury agency.
20% is treasury agency.
Okay, 20%.
But
treasury
40% is agency mortgages.
Is agency. So 50 to 60% in sort of what we might think of as more high quality. The TIPS allocation we throw into that, and there is a pretty good rebalancing range in that now. So at its current level, the fund has the exposure or the opportunity to be exposed as little as 10, 14, 15% in high quality fixed income, with some of the rest in the higher grade. And then with the additional allocations and decisions the board has made to increase further in opportunistic fixed income, in hedge funds, in private equity, and so forth, I think there has been some pretty significant moves toward diversification that have helped mitigate some of this. But I think we'd agree that there's more to do once the basket clause gets expanded.
Yeah. Now, and the only comment I'd make about 08, 09 is I'm willing to bet that years from now, when people look back and write the history of what effect that had on pension funds, we always fight the last war, and it was very painful, the equity shock. But the real damage to pension funds was not done by the equity markets, it was done by the Fed. Yeah. Oh, I'm just saying when we go back in the fullness of time and look back on 08, 09, we will realize that the damage that was done to pension funds was not from the equity markets. Yes, crashes are very unpleasant. It was done by the Fed, making rates so low.
Yep.
And I think that will be the case. So we all worry about equities because it's very painful to go through a crash and see a big chunk of your AUM evaporate. But the real threat to pension funds, in my mind, is the Federal Reserve continuing this policy.
And I don't think we disagree with that at all. But sort of the counter to that is sort of the point that this portfolio has a pretty significant equity risk exposure already.
Yes,
absolutely. Some of this is a degree of margins. I don't mean margin in a leverage way, but I mean a matter of degree. Could we take on a little bit more equity exposure in this? Yes, but is the portfolio at a pretty heavy equity exposure already? I think we'd argue yes, it is. Yes, it is also.
Now, at a previous board meeting, someone remembered that Bob had said we have to ride the wild tiger. I characterize what I'm saying is we got to ride 2 wild tigers now.
Yep.
Let me see if I can tame the circus a little. One tiger to add 2 is possible. Right, thank you. If you look back at what we've done since 08, 09, we've taken a lesson from 08, 09 and said, you got to get diversified because the wild tigers are killing us, right? So we've added leveraged loans, which are debt plus margin and float. We added more high yield, so we've made some gains. We had opportunistic fixed income, which is on-the-go money, but trying to get double-digit returns, so let's call that equity disguised as debt, kinda. We've said, let's get some more leverage, so we've added to private equity. And we've said, let's remove our US bias and go for growth, which is emerging market equities, right? So we've kinda, if you look at it, we've kinda made, I would say, we've made the right moves. And added hedge funds, you're right, sorry, excuse me. And added hedge funds, which make money of both, you know, in theory, coming and going, which is even better. So that's pretty good, you know, for a long-term pile of money, to make all those moves inside of less than 3 years. This was pretty damn good, I would tell you. The two constraints that I see, and that's doing all that is within the 25% basket. So I think your point is spot on. The problem is our box isn't shaped like everybody else's box. We have this constraint that sort of says it can only do up to here. So it really is imperative as we keep this 50-year fund going, you got to get room in the box, because all those good things I mentioned, you need more of, and more of different things also as you get into, you know, more real assets like infrastructure and timbers and MLP, stuff we've talked about, but we don't need room in the box anymore. So you got to increase the size of the box. That's number one. Number two, John, to your point about the Fed's got things pretty rigged up, they do. That being said, in the time span that Bob North lives in, that's just sort of a little wrinkle, right? Because it may have been sort of going on 5 years, but there's only a couple of years left of it. So you should have fixed it, you know, a couple of years ago, and you really would have had fun. So the good news is that constraint, which is ultimately going to help equities, that's what they wanted to do, is help equities, is coming off in, I'm not here to tell you how long, but in less than another 5 years, right? We'd like to hope if
I'll
it's
take
not.
over under.
You'll take the over-under? I'll bet you a slice of pizza. A New York slice of pizza, too. So, you know, I would tell you the biggest, so everything else is subject to managers and markets and all that kind of stuff. There's only so much you can do, and it all depends on your asset allocation, but there is an impediment in our asset allocation, which is this basket clause, which makes us have an inefficient frontier. As much as we try to maximize and have an efficient frontier, there's, you know, it cuts it off. So actually, if you stacked ours up next to something like an endowment model, you can't do it. Just not do it. So everything else being equal, you're right on risk, you're right on the other stuff we have. You just have to move our efficient frontier back, and somehow we have to go fix that. But I would say, you know, we've made a lot of progress since that last drawdown. And the key is trying to have more nimble money in more professional hands that can adapt to the volatility we're trying to create. So, but I take your point that the bottom line is the risk of payment. You've got to get way, way up. It's risk of payment, which I would also tell you will take care of itself with a nice dose of inflation, which I would also tell you is before you pay me for that pizza, we'll have inflation. I wouldn't mind inflation bet also, and then rates will go up, and then the risk-free rate goes up, and then everything's fine again. Right? That's what I. Any questions about risk?
Yeah, I'm thinking back to the last 10 years, and we made the 8%, a tiny bit shy. And we didn't have the basket clause above the 25. And we had what some people call the tech bubble, but I call Enron and WorldCom as well. And then we had the mortgage situation. So I just want to explain how we got the 8%, given all of those very negative things that occurred in this fund.
I think part of it is rates were higher then. So
The
8%
interest rates.
interest.
Yeah.
Or the fact.
So 8% was, you know, that's our yardstick, if you like. Yeah. So interest rates, 8% wasn't all that far from a corporate bond rate of 5-6%. Now it's much further away. So that's different. Also, there's the question of, are we going to really have robust growth again?
We're going to have what?
Robust growth, economic growth, which feeds back into everything else, all the other markets. A part of the growth we saw during that period was man-made, or Fed-made, if you like. We
In
created
a
bubbles.
positive way, though.
in a positive way, but then there's a negative way when a bubble bursts. And we always only look at the bursting of the bubble and go, oh my God, how did that happen? But while the bubble was growing, we're all very happy. You know, the stock markets are going up, 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 valuations are going up, up, up. But they're part of the one and the same thing. So the question is, will we have growth comparable to what we had in the past? Can we extrapolate the past behavior to an era in which we're a very demographically different country than we were 20 years ago? We have many fewer young people, many more old people, many of productivity advances that came out of automation and other things have already happened. So it's an interesting question whether we'll get it. But I'm a risk guy, so I assume no, the bad thing will happen, not the good thing. And so I assume we will have middling growth. And we will have, look, if we have spectacular growth and we're heavily in equities, my God, we'll make a ton of money. So what I'm worrying about is suppose we have middling growth and we have continued low rates. How do we make up for that? Because that to me is the risk to the portfolio.
And I would look at it a little differently. I would say, okay, we had 8 and a lot of volatility. How about 10 with less volatility?
Be
Better.
nice.
Thank you. Be nice. That's what all this is about, so that you can look back and say, all right, well, he's got this problem with interest rates, which is spot on, low rates. But looking back, I mean, and I don't know how to do it, maybe Callan can figure this out, homework assignment.
We have enough homework assignments.
If you took this asset allocation and you profiled it back 10 years, what would that rate of return be? Actual.
Well, in fact, as part of your asset allocation analysis that we did 2 years ago, we looked at that historically based on especially different market events. So yeah, that is.
And we got the less volatility, which was one of the keys, because the volatility is.
With the look back,
Yeah.
which is partly John's point here, that all of this is in that is somewhat look back. I think the other point I need to make this because since I was the one that piggybacked as soon as I could on seeing Larry's 10-year return over 10 years, part of this is an accident of timing. A 10-year return happened to hit at exactly the right time for me to make that point. If we had looked at this June 30th of 2012, the 10-year return would not have been 8% because of the accident of timing. If we looked at 15 years, it would not have been 10%. So there's a lot of things you can do with numbers. So I need to acknowledge that. But nonetheless, I think one of the other things, sort of look back over past history, was in an 8% return expectation from Bob's standpoint. Is it still 8% that you're using, Bob, in your analysis? Is 8% the number? Is 7% now the number?
Actual interest rate assumption is currently 7% net of expenses.
Right. But and again, that's not that, as Bob has pointed out, you don't necessarily use that number to help develop the asset allocation. But nonetheless, the expectation going forward over a 10-year period of time, based on capital market projections, would get you pretty close to that 7%. But you can't eat capital market projections. But nonetheless, there is some level of expectation that the current asset allocation plus some level of alpha from the type of investments that Larry's talked about in a median case scenario should get you close to that. But you can't eat those returns. We'll see what happens in the markets.
Any other questions? Food for thought. Okay.
Thank you, John. So the next item on the agenda is discussion about a divestment policy. And I'm not sure who wants to kick off the discussion, whether it's Jimmy or Callan.
So I guess, first I just want to check that the board is okay with Callan making this presentation. It's the last that we left off. There seemed to be an informal consensus that we would take this matter to the ESG committee for further consideration. But since this issue is just is new to us and Callan's just produced all this background information, and since technically the ESG committee is the committee of the whole, we thought it might It's not? Oh, okay. Well, I thought, oh, it was a, okay, maybe I'm sorry, I mistook that with some other committee. Thought it would be useful to have just a basic presentation of the background research that Callan was able to find on this important issue.
Okay, so to go over the memo that we put together, I'm going to have Tom Shingler come up and walk you through that, since he did a lot of the investigative work about what other plans, large public plans, have done in the area of a generic, divestment policy, when and how to go about creating one. So Tom's going to come up here. Tom, as you know, has been with Callan for the last 2.5 years and works closely with Mark and I. And so he's going to share with you what he found about others' divestment policies.
So our memo starts on page 78 of the packet. I also have copies. So just as some background, we prepared this in response to the request from the board at the January 22nd meeting. We consider this to be a document in draft form at this point, just given the limited time since the last meeting, and because of that limited time, we haven't had the opportunity to go through our normal comprehensive internal peer review process. In terms of the examples we've included here, these are for observation only at this point, and any policy specifically for NYCERS would need to be developed with the specific needs and objectives of NYCERS in mind. Another caution I'd like to make is that none of this should be considered legal opinion or advice. In the development of any broad divestment policy, legal counsel would need to be consulted. When we were looking into this topic and the development of a comprehensive divestment policy, we looked at a number of other large public funds. So we targeted the peer group of the closest peer group of the top 10 public funds in the country. We also sourced our own very broad and deep network of public fund sources, either clients or non-clients. And those were public funds ranging in a pretty broad size from about $2 billion to over $200 billion in assets. We think the research we have here is comprehensive and reflective of public funds divestment policies at this stage. The only fund that we're aware of that has a broad, comprehensive policy that's a peer of NYCERS would be CalSTRS. We included that policy in the appendix. We also included a couple of other broad, relevant policies. One is State of Connecticut's, where they tie it in with their ESG and corporate governance policy, and the other is CalPERS. In terms of why and how other public funds have developed divestment policies, they've typically been in response to either specific events, crises, social issues, and often in reaction to state legislation. So most of the policies that we found were enacted in response to legislation as opposed to proactively created. Just to give a little bit of historical background, there is a long history of aligning social and investment goals. In terms of the institutional investment community, that really started to come to a head in the 80s. One that some might remember is the South Africa free investing policy that public funds and endowments and foundations enacted in the 80s. Tobacco was another very hot topic of divestment in the 80s and the 90s. And into the 2000s. Then also, more recently, you've seen legislation play a role in divestment policy. So the Sudan Divestment Act of 2007 that state funds and some municipal funds reacted to. And then piggybacking off that, there was legislation in 2009 on divesting from energy company investments in Iran. So there's been a bit of a change towards government legislation impacting divesting. And then, of course, most recently, the gun and ammunition manufacturing divesting issue with the tragedies at Sandy Hook Elementary, bringing that to the forefront. So there is a long history there of divestment issues bubbling up over time. Now, one issue, and you see this in the CalSTRS policy as an example, is the concept of engagement rather than divestment. So often large institutional investors are not in a position to divest. It could be the fact that you're in index funds that have these investments, and your policies are written in such a way that you own the whole index. So you're not in a position to divest. Or you're in commingled investments. Or the positions are simply too large to divest. So there are a lot of reasons why funds are in positions where they can't divest, and that brings into the concept of engagement rather than divestment. And there are a lot of facets to that, be it proxy voting or media campaigns, meeting with management. CalSTRS has a good amount of detail in their policy about all the steps taken on the engagement front before you get to the divestment stage. And one way of thinking about divesting is an option that you can use when you've exhausted the options on the engagement front. And part of the logic of that is that effectively when you divest, you lose your seat at the table. You're no longer an owner. So you don't have that same say that you have when you are an owner. But if the divestment stage is reached, there is effectively two main camps in terms of the view on whether divesting is prudent or not. So you've got one camp, and we saw an example of this in reaction to Sudan legislation in 2007, is the camp of the fiduciary responsibility is simply to act in the best financial interests of beneficiaries. So any other motivation should not be considered, and that would be a camp that would not agree with divesting. Now, on the other hand, you have proponents that will argue that considering other factors, economic, social, political, risks to investments that could ultimately impact shareholder value, could impact the valuation of investments, should also be considered. So looking at the two in conjunction with each other. A good example of this would be if there is the threat of major litigation to a particular company or to an industry as a whole, that on a prudent basis it may make sense with that on the horizon to divest of those investments on a prudent basis. Now, one way from a comprehensive divestment policy perspective to address that is to establish a set of risk factors for investments. And then when those risk factors are breached, as the example I gave with legislation, once those are breached, then you consider whether or not to divest. But ultimately, the decision to divest from a fiduciary obligation perspective has to be made based on financial considerations. Now, if NYCERS were to proceed and develop a comprehensive divestment policy, one question that arises from our perspective is, does having a divestment policy, having a broad policy, does that encourage divestment? There are always going to be issues that bubble up, various campaigns for divesting. Almost any investment, there's going to be a side that opposes it. And as a large, high-profile public fund, does having a broad divestment policy encourage divestment campaigns that might be undesirable and they might not have economic benefit? Now, the counter to that is that if you have a broad policy, you have a decision-making framework that you can use on an ongoing basis as opposed to reacting on the fly to each event that arises. There are some other factors to consider, complications or implementation issues with divesting. One is simply cost, so any short-term loss that can be incurred, for instance. A second is internal resources. These may be outsourced, but there are resources that have to be applied to divesting, so it's maintaining a watch list of companies, monitoring investments, ensuring compliance from managers. That requires significant resources. Another issue is market impact. So it may be the case that divesting has negligible impact on the performance of these companies. And this is only if the divesting gets very broad, but do you run into an issue of restricting the investment universe, depending on how broad you get into the divesting field? And this really applies more typically to foundations or endowments that have very broad categories of investments they cannot hold. We also highlighted some specific implementation considerations, and this has come up in the gun and ammunition discussion. So one of the first considerations is what types of securities and investments should be divested, whether it's public or privately owned companies, whether it's U.S. versus non-U.S. stocks, whether it's stocks versus bonds. And then you also have the investment vehicle considerations, so separately managed accounts versus any type of commingled vehicle or LP structure. In the policies that we have seen, typically the policies are focused on separately managed accounts, where the divestments would occur there, and you would have exemptions for instance, index funds, where if you're buying an index, you're buying the whole index, or an LP structure where you don't have the same control, or a commingled vehicle where you'd have to divest of the whole vehicle. So there are some specific considerations there. There's also identifying what your list is of companies that are up for divestment. So oftentimes large public funds will use an outside source, whether it's MSCI or ISS, another source, to come up with the list of companies. Then establishing what the value is, so what is the exposure, what would be the impact. And then there are a lot of considerations if action is taken to go through the process of divesting. And in establishing any kind of policy along those lines, you would need clearer guidelines for the process as well as the types of securities and the types of investments. So having precise language that defines what's included versus what is exempted from any divestment policy. In our view, from a next step perspective, and this is true in looking at some of the other policies like State of Connecticut's policy, is that this is a topic that has a lot in common with the general corporate governance topic, with ESG issues, proxy voting, emerging market screens. There are a lot of commonalities with regard to all these issues. And we would suggest either the current subcommittee that's looking at some of these topics add this to the list, this comprehensive divestment policy topic, or some kind of newly formed corporate governance committee to explore this and do further work along these lines.
Thank you. Does anyone have questions? No? So this was very educational for me, so thank you for adding it to the agenda. And I believe that this item would best be delegated to the existing ESG committee for further study. However, I also believe that this is an extreme policy option and should only be used as a last resort. Does anyone else, either John?
Madam Chair, I think it's correct that the previous meeting we had got a sense of the board to have the present subcommittee on ESG issues take this up. I also just asked when they do take it up to take into consideration some safeguards, that there is no immediacy, knee-jerk reaction to current events in the newspaper when taking up these goals, but that there's a thoughtful, reasoned process that's undertaken. And that, yes, it may be just in extreme situations. And the other thing I always like to consider is what I call the Hall of Fame rule, so to speak. You don't take up anything within the period of time after the event takes place. So there's a cooling off period. So if we want to divest from South Africa, that we give it a 6-month period of time before we make a final determination on that, or a year's period of time before we make a final determination on that, so that there's enough time for it to develop, so that we're not responding very quickly and haphazardly, with all in good nature and with the best intentions, but the best intentions sometimes take it without the ruling. So I'd like some built-in time period, and just for consideration, by the way, when we come to that. And finally, I'd like to take up also as an alternative to divestiture, something we did in the past on this board with tobacco, where we say, okay, well, while we live with what we have now, we will make no investments in the future as an alternative to full divestiture. So I think that's something that I'd ask that the subcommittee consider.
Yeah, absolutely. Let me make 1,000% clear to you that I 100% agree with everything that you said, that my purpose in bringing up the idea of a comprehensive divestment policy is in no way whatsoever to encourage divestment, but to set up a very rigorous, purely economically based rationale that is consistently and very carefully and thoughtfully applied to every single decision about a divestment that may ever come to the board. And I fully agree, it's a very complex analysis that has to happen, that has to consider a lot of criteria, and there's not always, and there are many alternatives: freezing, divestiture, engagement, looking at the different types of assets that we want to change our treatment of. And I fully agree. I think the purpose of this policy is to completely avoid knee-jerk responses to headlines.
Jim,
And
if I may, I really had no doubt of that when you made the proposal and just laying it out there for everybody to consider the future. But that was never a question in my mind about your presentation and where you were looking to go. So if I felt that way, I apologize.
Thank you. So are we all in agreement that this would go back to the ESG subcommittee for further study?
Yes.
All right, thank you, everyone. Thank you, Todd. The last item on the public agenda is a discussion about a quarterly compliance report. And I have some additional handouts in case anybody needs them. So just by way of background, to frame today's discussion, we know that any board's investment policy statement is a significant driver of risk-return performance. And once a board establishes an investment policy statement, or as we refer to them as IPSs, a board continually measures and evaluates the IPS to understand its effectiveness in meeting its risk-return goals. And it also continually measures and evaluates the positive and negative effects of any deviations from an IPS. So based on this measurement and evaluation, a board may then decide to enhance its IPS and or fine-tune its risk control processes, thereby creating this sort of feedback loop. So you don't just put a policy in place and set it and forget it. You're constantly looking at it, you're monitoring it, and fine-tuning and tweaking it. So what I'm going to hand out for you is just a copy that I've taken from the fiscal year-end performance report that we receive every quarter. And what this is, and continues to be, is our primary measure of how deviations from the IPS affect the plan's returns. So I'll wait till everybody has a copy of that, and then focus you on a couple of points in this handout. So if you look at the first page of this handout, which everybody's seen before, by the way, the orange bar to the right is the policy index, and that shows what our investment policy or our asset allocation would have done over the 12-month period ending June 30, 2012, which is our fiscal year end. And you can see that our policy return was 3%, which is well within the band of what we expect. We actually expect, based on our new asset allocation, that our returns are going to be between negative 5.5% and positive 20% 2/3 of the time over any given year. So we have a pretty wide range of return expectations, with 7.3 being the median of that return. Now, if you look at the navy bar on the left of the first page, you see what the deviations from the IPS resulted in. So we had a negative effect of 1% based on deviations from our policy return, which is over $420 million a year if we base that on our beginning market values for the fiscal year. If you look at the second page in the handout, you'll see a very similar looking chart. And this is the same analysis, but for the 3-year period. And you see a similar negative effect. If you look at that navy blue bar, you'll see that deviations from policy resulted in about a negative 80 basis points in terms of our return. And then the final page, which again we see every quarter, measures how the deviations helped or hurt in each asset class. And so you can see that, for example, for the 12-month period, domestic fixed income was the largest detractor from the policy return at about a negative 70 basis points. So we do regularly measure this. We regularly measure the effect of deviations from the IPS. But what I'm asking that we focus on is a systematic evaluation of the deviations to better understand their impact on plan returns. So as I just mentioned, that negative 71 basis points is there, but we really don't dig any deeper than that. We see it, we look at it, and then we move on. We don't actually talk about what the cause is, evaluate our decision-making process that led to this deviation, and see if there are any changes that need to be made as a result. So what I'm proposing is that a compliance reporting mechanism is a valuable tool for starting to evaluate deviations from our policy and the effects on return. And that was the handout that was provided to you sent to you in the board. It actually didn't make it into the board package, but we handed it out earlier. Yeah, that one page thing. So what we currently receive now in terms of compliance reporting is a page in the monthly performance report where we see what our ranges are for each asset class and where we are within each of those ranges. And I'm suggesting that we might want to enhance that reporting on a quarterly basis to more of a one-page executive compliance report that focuses in on where else we might be deviating from our policy and giving us some sort of an evaluation on how that's affecting performance on an ongoing basis. What I'm suggesting is that it be performed by an independent third party. There are software companies that provide this type of reporting on a regular basis, so it doesn't have to be a manual type exercise. And I'm suggesting that it might come to the investment committee versus the full board, since that's where we deal with most investment matters. And typically, in my experience, it's been a custodian bank who's able to provide such reports versus a consultant. But we should examine all options on where this type of reporting might originate. So this is really just a discussion topic to bring it to the table today. See if anybody has any questions. See if we have this, perhaps ask if we have this capability today through our current custodian bank.
Well, can I ask a question?
Sure.
Do we have this capability to do it internally?
Don't we get this every quarter from Cal? Don't we get a big fat telephone book from Cal?
Do we get
Well, we just so taking the fat telephone book and make it, a manageable document is really, and then, right? Because you get the information from the custodian, right?
I mean, I think they present once a quarter.
Yeah, but I'm saying in something boiled down version where
We present attribution
Right.
versus the long-term target, and then we started doing against the interim target. But what we don't get into is to the nuances and the detail of where that all comes from. Drilling down and to what extent that deviation from the target existed, and for how long did it exist, and was it, what were the reasons for it? We just show you, similar to this chart, as to what were the effects of it.
So I'm suggesting that it's a useful exercise to understand the reasons for the return deviations and decide, do we want to continue with this? Is there something we need to change in either our policy or our process to ensure that we're getting closer to what our policy return is? I mean, obviously our goal, because we are using active management extensively in this plan, is to exceed our policy return, right? And we want to at least equal, if not exceed, our policy return. And so I posed the question to BAM, is compliance reporting something that our current custodian has the capability of providing?
I'm not sure. But I mean, I'm not sure what we'd be asking them to do. As you know, we're in the process of an RFP for a new custodian. Not new, not necessarily, but the contract lapsed, so we have an RFP going for a custodian. It's in process as we speak.
And it's supposed to conclude in the fall?
It's supposed to conclude, I think the selection would be this fiscal year, implemented by the end of the calendar year, if possible. Depends if the incumbent is the winner or someone else is the winner, because that obviously has to do with time to execute and implement.
So I guess my question then is twofold. Is this something that our current custodian can do and start providing to us on a quarterly basis right away? Or is this something that we need to examine as a service that might be provided by our new custodian and consider that as part of the evaluation process as you're going through the selection?
Have you issued the RFP? It's probably too late to add it. Is it an RFP?
It's totally too late to add it.
Yeah.
Because its final bids are in, we've got the BAFOs, I think we're selecting it. Who'd be up to date on that? What's that?
So,
I think we're selecting it in the next.
well, I wouldn't say that we're selecting. I think we're going through a lot of the processes that one goes on with procurement, so I wouldn't want to put a date on it. But I do think that Larry and David make a good point that we're well along a path. So to change that path at this point relative to Janice's ask, I think is not practical. To get away from more the point of sort of where we are in the process point. I think David and Larry make a good point as to sort of what the scope of the work is.
But I can check. I mean, I can. To the extent I understand what you're looking for, I can check the current proposers and see if they have it. I presume they do.
Okay. That would be helpful. Bob, do you have a question?
Yeah, it's more along the line of a question about what's being sought by this. I think to a large extent, numbers already exist for the board, but it appears that many of the bullets are really more looking for the reasons behind the numbers.
Right.
And a couple of questions. One would be, is someone independent and third party able to provide that kind of qualitative analysis, or does that really have to come from an internal self-evaluation?
And I don't know the answer to that. And I think it does depend on the services that these custodian banks that we're examining have. And I just don't know the answer. Whether what you get is just a simple printout of, here are your policy and guidelines, here's where you're in compliance and here's where you're not in compliance, or if you get some qualitative analysis. I simply don't know the answer. But perhaps Larry can look into that for us.
I'll see.
Can I just ask a question? Because
Sure.
I'm confused. In that it seems to me.
Can you speak up?
It seems to me that the nuance, the interpretation, is obvious to everyone in this room. we've been underweight fixed income during the rally, so we underperformed. If rates had backed up, we would have overperformed. We also keep some money in cash, and there's no policy for cash, but you have to have cash because you got to pay things and have a parking place. Beyond that, I don't see what you're going to find. I mean, you're asking to have an RFP to tell us something that we already know because it's obvious.
Well, I don't know. Is it obvious to everyone? It wasn't so obvious to me, actually. So if I were to ask any of you in the room where this 71 basis points came from over the 12-month period, would you have been able to have answered that question?
I would, I mean, we have all these charts. It might
Well,
be.
you should be able to.
No, it might be you need to be walking through, I mean, again, if I look at the history of these charts that we've provided you, BAM has continually been told, don't tell us about these charts. We can read these charts ourselves. In fact, you've told us that, Madam Chairman. Don't walk us through it. Spend as little time as possible. The board is up to speed, is educated enough to understand the numbers. So now you're saying something completely opposite, if I can point out. But the reason, some of the reason for this is we all recall when we went through this every month with the numbers, there was a period last year, it was last year, when we were very defensive and went to cash. And to your point, we went to cash, missed the rally, and that's all there is. It's sort of not so, it's not high math. But again, we walk through those numbers every month, and it's a sum total on this page here. We have the monthly, how we're doing relative to the benchmark. So I mean, if you want to drill down, we have every manager's over and under. I mean, I would tell you we have too much information.
Okay. And just
But-
Larry, may I say that I've never said, do not look at these quarterly attribution numbers. What I have said is that monthly returns are just a lot of noise, and it's the longer term results that are meaningful. And what I am trying to get at is an interpretation of the longer term results, not merely saying, here's what the return was. What I want to know is why, and how do we feel about that? Do we want to continue going down the current policy, using the current processes, or do we want to have that feedback evaluation loop and continue to evaluate what it is that we're doing and make adjustments? And so I also, to get back to my question, if I had said to any of my fellow board members, just picked on one of you randomly, this 71 basis points, could all of you have explained to me what that was where that negative 71 basis points was coming from? Larry should know because he's Chief Investment Officer.
In answer to your question, Madam Chair, I think yes, I'd have to go back to my office and pull out the last, 1 year or 3 years worth of monthly reports and go over it and say it's because of this and this and this and this time period. It would have been readily available to me today now. But I think, with a little digging it could have been. I think what maybe you're asking, if I'm correct, is a distillation of the past quarter, past year, into a one-page format so we wouldn't have to go do the dig on a month-by-month basis to look at the pie charts and the bands at that point in time.
Exactly.
I think that,
Yeah.
I think that could be done and resolved and easy and go forward with that. In terms of the qualitative, the only people who can tell you why are the people who did it. I can't think a third party can do that. And I think, to be fair, every month they're telling us why when there's something changes, but maybe we're not just getting, or the cumulative effect of it isn't really getting into our heads, is what maybe what you're saying. Am I right or wrong? Or?
Yes, I feel like I have this information, but nothing behind it to drill down to understand where these numbers are coming from. We do get a lot of detail on the gray bar. So on page 1 and 2, we've got the plan return versus policy weights, and we do get tons of information on the management effect, what managers are doing, which manager underperformed and outperformed. But what we don't get a lot of detail on is the policy effect.
To your point, Janice, about the longer-term history, those reports that we started doing a year and a half ago, we are building that history as we go quarter to quarter, and we are showing, this policy effect over time. and it does show by asset class. But what it doesn't get at is some of the other things that are on this page about manager compliance, leverage, index versus active. And so if you're just talking about, well, why is it that we underperformed for this period of time if the managers were at the benchmark? I mean, we can get to that through our reports. But it depends on the type of detail that you're looking for. And sort of the explanation as to why the fund may have been deviated from policy, we would then have to go to BAM and discuss it with them.
Is that something that you can do for us, to give us that greater detail?
I mean, frankly, I don't think that's the type of thing that we typically do. I mean, I think BAM talks, you know, when there's, as I think back to discussions over the past, past number of years, when performance has underperformed or outperformed, I think part of what BAM does at their the discussions is the discussion of, we overweight here, or we underweight here, or we're, holding cash for opportunistic investing, or, so I think there is that level of qualitative discussion, and I guess I would have a hard time thinking about how someone else can sort of get to the issue of why things were done. I do think that the attribution we do is built on a quarterly and long-term basis. And so I think the reports that we have done and shared with the board have been useful to that regard, very useful to that regard. Shorter interim times in between that, I think, if they are necessary, and I leave that to the board to decide if that's necessary, are really beyond the scope of what a consultant is able to do in their performance reports. So I guess maybe the thought is, I think it's next month that we'll come in with our December report, and maybe with a greater eye toward what that does, the board could see, all right, what does that do coincident with what BAM provides in their reports, and see if more might be necessary.
I would like to further explore that linkage between Callan's reports and some sort of a compliance report to the board. So this doesn't have to be solved today, but I think that Larry has agreed to go back and do some further research for us, and thank you. We look forward to hearing back. And so that, yes, Al?
I just want to say one thing. I think with respect to the manager effect, I think the first time that Callan made the presentation where they showed short-term and long-term manager and allocation effects, that was very important to me as a trustee, because it helped me make, this is a real basic component of what's happening with the fund. And so I found that very useful. Drilling down to figure out long-term what's happening with our manager selection, I think would be a good thing. With respect to our, allocation of investments, I mean, given what's happened in the last 3 or 4 years, I don't know how we can tell anything about anything. We go out of compliance because of wild swings in the market, and what I think BAM has tried to do is to ride those swings out in a pretty reasonable and rational manner, so that we're not whipsawed the next time we have a dislocation in the market. I'm not sure what we would get out of trying to figure out what's happening with our allocation on a quarterly basis.
The idea is that we sometimes as a board make conscious decisions to go outside of our own policy. And when we do that, we should really thoughtfully evaluate what the short-term and the long-term effect of that is. So, for example, we did make a decision to greatly exceed our cash policy, which was originally 0, and we were up above 10% in cash. And if we are to believe what we see in these reports, that was a negative effect. And so we should have these sort of soul-searching type of discussions and say, why did we do it in the first place? What was the effect? Was it a good idea? What did we learn? And should we ever do it again?
Janice, didn't we, you know, investing is a complicated thing. If you talk about it once a month and you kind of say, all right, let's do it, or all right, or you want to stop, or you kind of agree to it, you know, sometimes you're right and sometimes you're not. If you want, we can analyze every time we made money, every time we didn't, but I tell you, we make money sometimes and not make money other times. But
There was some discussion.
maybe we talk about it, that's why we have it every month, we show you, so that's what we're doing, here's why we're doing it, this is what we're worried about, you guys with us, you know, and if everyone says, nah, you know, we don't like it, well, all right, we stop, and then we stay within these ranges.
Larry, at the time, you did discuss why you went to cash. Why
Right.
You gave a rationale.
Every month.
We heard it.
Took us a whole year to do it.
It makes sense.
It was, well, I mean, wasn't it?
The euro was blown
going-
apart.
It was, and it made sense because we have to pay out.
Right.
Well,
We're all there for it.
The other comment I would make, Madam Chair, is that something I think is missing off of this is, once we're out of range, you would need to not only calculate how that would affect the portfolio, you would need to calculate how much it would cost to get back in range. Because what we've seen is that once we've gone out of range, it could be very costly for us to try to get back in, get back within the range in a short period of time. So, I mean, I'm not sure what a quarterly report gets us with respect to that kind of thing. Maybe looking at it on a longer term, I mean, looking at it on a longer term as opposed to short-term actions that you would take might give us some historical information that would prove useful at some point, but I'm not clear where we get on the range information.
So, and everyone, I kind of think of it this way. We have these compliance targets and rules, checks and balances in place for the managers. BAM and the custodian keep tabs on that. And that's because we delegate security selection and money management to these managers. What this is essentially to keep tabs on the board's progress in managing what it owns, which is, you know, we have this policy index, and for example, right now, we don't really know what our tracking error is for the most part versus that policy just being passive. And so what you put in place is a risk budget system, and part of it does keep track of, you know, frictional costs of staying right at the mid-range of the policy, the adjusted range, and that would factor in. And along the way, we keep tabs on that, you know, what is our tracking error? You know, we could, based on that, probably deduce if we had a higher or lower tracking error, would it be optimal as far as meeting, you know, our goals, objectives as a board. And I think essentially what we're trying to put in place is, you know, replicate what we are doing for the manager selection evaluation part of our role to what the board ultimately has control of, and to learn from that, you know, when manager selection maybe isn't going as we had hoped, we learn from that, we modify, enhance it. This would essentially help us do the same, and it's not to, you know, be distracted by quarterly swings. It's to look back over a 3-5 year basis, have this data information, and be able to deduce what, you know, we can fine tune as a board in our processes. So, and feel free to fill in if I left anything out there.
No, that's just another aspect of policy management is having a risk budget. But that's a topic for another day. because we could spend a good long amount of time on that. So unless there are any other questions about this topic, I suggest that we move on. Okay, so that ends the public session for today's agenda. Do we have a motion to exit public session and enter executive session? Do we have a second?
Second.
Any discussion? All in favor? Any opposed? Okay, we are, need to wait for the cameras to turn off. Should we take a break?